Bitcoin to get subscribers or to sell something, okay? I am telling you straight to your face that there is absolutely no need to buy any course of mine. You do not need to get anything through me at all. Alright? Now the second thing is that something called a funding challenge has arrived in the market, on which I have personally done some very solid research, and I have reached this conclusion so far that in my opinion, not even a single company is good among those that are currently giving you money. For all of these people, what exactly happens? So what happens with funding is they tell you to give $100 or $200, buy the challenge, pass it, and you'll get a huge payout. You get lured in by those big numbers. But brother, if you don't know how to earn, what are you even going to do? For example, first, 95 out of 100 people will lose. Everyone knows that initially only 5% win, but the problem is they don't even pay out these 5%. They themselves take a dummy name and keep saying they gave this much payout to this person, that much to that person. They aren't even real people. Why? IP violation. I have so many students, 13 subscribers. They email me, WhatsApp me, send photos. By applying a rule called IP violation, your account is snatched away. They say, okay, you've passed the challenge. He ruined my mood, man. Owner says I ruined the mood of this company. I won the challenge. Fine, let's settle this now. See, I gave you a $100,000 account, or for example, a $10,000 account. You know, one trade on, and you'll lose over 3% anyway. Over 4, they'll just take your account. You traded well, making profit, but you have to give them profit. So what do? And they make excuses that today you logged in from your mobile. Like that you said, how did you log in from a different location with your laptop? And I tell them every time, a trader means location freedom. I can go anywhere, travel around. They say you'll have to trade from the same place. If your home Wi-Fi changes, you must inform us, provide a flight ticket, and it's only allowed once. It will be snatched away no matter what. Look, my problem isn't that you'll lose money. My problem is that the supply chain will break. You'll win an account with your hard work, you'll get an account. Now imagine your life is set and it's snatched away. So why are you spoiling your mood? Trade with $100, $200, $300 and earn some returns. And when your RI turns positive, then that one thing I strictly forbade you from doing, which was taking money from people, now you absolutely can. If your RI is indeed positive, then go ahead and get some capital, say 500,000 from any relative, your closest best friend, or even your brother or sister-in-law, and start trading. Your career will start growing through the power of automatic compounding, right? If someone is promoting any type of product, they certainly get a commission. For example, if you join Access, I will also receive a commission from your trading. And what's wrong with that? If you're not using anything else, I simply suggested what I personally use. However, I don't promote a single funding challenge myself. I finally know the bad one. I don't want money that makes me sad because it's not really losing money. So there's another trap, brother. Be careful with it. People aren't thinking about learning. They're just doing funding. And yes, there are good companies in the international market. My research is ongoing. I'll make a video on it. So stay tuned. The third trap, never ever give any money to anyone in the name of booming bulls or those so-called influencers. Like, they are all just scams. Like, if someone asks you to pay them $200 or $300 promising profit returns, this is also a scam. So please don't fall for such schemes. Now, you are smart enough to decide for yourself what exactly you should do. So this trading roadmap video, I've now made it for you as a complete step-by-step guide. Did this video turn out to be too fast-paced? I know many of you must have enjoyed it, those who paid close attention, but many people will still have some doubts. So do one thing, just post your doubt in the comments and I'll reply. I'll make a video to explain what your doubt is all about. I'm starting to make shorts. I'll upload reels and shorts on YouTube. Making videos to address your doubts. Any comments related to this video? And now I'll tell you about the giveaway. I'll give away 100,000 rupees. Your trading capital will be 10,000 for 10 people and $100 for 10 people. What do you need to do? Nothing. You just have to submit a summary of this video, whoever writes the most beautiful summary. And there are two more steps. First, write a good summary of this video. Secondly, you need to go to Instagram and follow me. Third, you must share it on WhatsApp or Instagram, wherever you can. Take a screenshot and save it. And once I see a summary that I find beautiful and genuine, because I'll know if the person has watched the video from start to finish, I will read and choose it, then launch it on my Instagram on this date. In the story, it'll say these 10 people have won, Yagi, or you email us to claim your award, then an email will arrive. If you've won, we'll ask for a screenshot of that share and check if you followed. So if you follow these steps, I'll also give you a 1 lakh giveaway. The fair value gap is a concept that's quite well known by name within the trading industry. While they might have a basic idea, they often don't know how to effectively use it. So in today's video, I will explain to you precisely how both the fair value gap and the inverse fair value gap function. There are many, but how to spot the best ones among them. I will also show a real example where 1.2 million rupees were made using this, after which I am making this video for you because I had uploaded a short about it. So let's start this video. First, let's understand exactly what this fair value gap is. So whether it's the fair value gap or the inverse fair value gap, once we clearly understand FVG, then the inverse FVG will also begin to make perfect sense. A fair value gap, it essentially points to an imbalance. Now, what exactly does imbalance mean? It's when there's a significant imbalance between buyers and sellers. When a really large buying pressure comes in, that's what we call an imbalance. For instance, let's assume a green candle forms right here. After that, a very large green candle forms, okay? And after that, one where the wick is very small or almost non-existent. The next candle can be red or green, but let's just make it a red one, for example. So a candle like this forms. So whenever we encounter a structure like this, where the middle body is very large, not just the wick. A long candle can also have a long wick, but we are specifically talking about the body here. We will understand which time frame this applies to. So whenever I refer to this as candle number 1 and refer to this as candle number 2 and refer to this as candle number 3, then the second candle situated between 1 and 3 is the most important one. Now consider the distance between the top of candle 1 and the bottom of candle 3, between the high of 1 and the low of 3. If I draw a gap right here in this manner, then we will refer to this as a fair value gap. Many of you might already be familiar with this concept, and those who were not aware have now learned about it. This is what we call a fair value gap. And why do we call it that? Well, look, because right after this particular candle, such a massive candle appeared here, this clearly indicates that there's definitely institutional money, smart money involved here, meaning the big traders. Because if such a significant amount of buying is occurring in gold or Bitcoin or even in something like Nifty, a single retail trader simply cannot move such a large market. So this level here, there's a significant amount of interest from people. This gap that is created clearly indicates an imbalance. So how do we actually trade this? I will come to that specific point. Okay, now before that, let's understand how a negative fair value gap is formed. Suppose a red candle forms and then a very large red candle forms, right? After that, a green candle forms. Suppose a hammer forms, then how will a fair value gap be created here? Mercedes says we'll say it again and we'll do the marking. This will be called 1, this will be called 2, and this will be called 3. The difference between 1 and 3, for example, if we draw a line from here and consider its height, then this area that forms will be our fair value gap. Okay, so first I've explained the basics to you. What exactly is a fair value gap? Now, we'll move on to the next level and understand that within the fair value gap, we also need to learn to draw an additional level. That is the 50% mark here. This will also prove to be very useful for us. Okay, so you will learn to mark this 50% level, which indicates a center point, and we will learn about a concept called premium and discount here. I will explain that to you later. So we have successfully understood the fair value gap. All right, now how do we actually use this? So how exactly do we use this, guys? Let's consider an example where, for instance, the market has formed the green candle. Okay, it formed a green candle like this. Then it formed a very large bodied green candle right here. After that, the market created a red candle, for example, something like this. So where will the fair value gap be formed? The fair value gap will be formed in this specific area. All right, in this area. And what I've done for you is also drawn a middle line here. Now, what do we need to trade? The market's concept, specifically the fair value gap concept, states that the market will definitely come to fill this gap. Now, whether it fills it completely or just 50%, that's what price action will tell us, which we'll see in our examples. Sometimes it will reach this level, sometimes it will reach that level. If we get a bullish candle at both these levels, then we need to go long here. This is what's known as the fair value gap concept. This means if the very next candle turns green here, many times we feel that our stop loss will be hit. But if you enter such a large candle, it should carry where would you place your stop loss? You can't place such a large stop loss. So we wait for the market to form a red candle, then another red candle. And if it creates some action like this around here, then that makes a very good entry for us. We get a very good long entry here. So this is the concept, guys. We need to initiate our buying position at this specific point. And by initiating our buy at this point, we aim to capture a long trade like this. The stop loss we get is also quite small, and we can achieve targets of 1 to 3, 1 to 2, or even 1 to 4, depending on where the resistance level is located. This then is an example of a bullish fair value gap. Now allow me to present a clear example for your understanding. And when this specific condition or setup ultimately fails to perform as expected, what we then observe is the subsequent formation of something known as an inverted fair value gap. For a comprehensive explanation of that particular concept, please make sure to stay tuned. And now let's proceed to understand this concept further in detail. We will only get good results if we trade specifically on the fair value gap. I will show you a live example, no problem. So what will be formed here? This fair value gap, and where will its middle point be? This will be the middle point. I'll show you how to scale on TradingView. We'll create it using the scale. So our concept says if I short this candle and it turns into a red candle, I won't keep such a large stop loss, right? So here the risk reward becomes poor because my target is only up to here, but the stop loss is so big. But to improve that risk reward, sometimes it will just fall directly. So don't worry, you won't regret it. Still, your money won't be lost out. You really number says, at the very least, Allah learn to abandon such direct breakouts if they happen to fall. But if the market here forms a large green candle and then another large green candle and then yet another large green candle. But as it comes all the way here, touching this, for example, if it forms a red candle of this particular kind, then for me, this is a shooting point. This will be my short entry. Here, I need to create a sell entry, or basically a short sell entry. My stop loss will be small and my target will be large. That's my goal. So this is how the fair value gap works. Okay, I've explained this concept to you on the iPad, and I'll also take you to the screen and give you all the examples one by one. Before we go to examples and directly go to TradingView, let's learn what an inverse fair value gap is. You've already seen what FVG is, haven't you? Now, after FVG, HT odstega paid CCKBS. We'll understand what an inverse fair value gap is, because the CRC, let's say you took an FVG trade and it failed, then you can also take an inverse FVG trade. Usually it won't fail. You'll also directly find an inverse FVG trend because it will mitigate directly. Your gap will be filled directly. Basically, it will be violated in short. There are many English words. It's very simple. We'll understand. Okay, now let's understand the bullish example. First, we see a small green candle form, or rather, a large green candle forms. And only if a large green candle forms will it truly catch our attention. Otherwise, look, fair value gaps can also form like this. There was one candle, then another candle formed, then a third candle formed. So a fair value gap was created here too. But these specific examples don't work as effectively. Your first and third candles should be small, and the middle second candle should be quite large. If you better just begin to apply this one small quality difference, because the indicators you find on TradingView, both free and paid, they all catch FVGs and you end up trading them and losing. So if you feel this isn't useful or the video is not helpful, then watch it completely and apply it after I explain the full concept. You'll really enjoy it. Let's move on to the next candle. Suppose it's a green candle and it's small. Where will the fair value gap form? Guys, it'll form right here. Now, even if you consider just 50% of the market from this, now the market says, all right, this 50% rule, let me explain to you what it actually is. Now let's talk about the market's fair value gap. This is not an example of an inverse gap. In a fair value gap, when the market comes down, the upper area, the market also turns around from there. But when the market turns around from this specific area, it's considered a very good zone because the stop loss is quite small. If you enter here, you'll still have to place the stop loss below. That's why they split this area. Entries made at the lower price levels are referred to as quality entries. For entries at the higher levels, you can use terms such as low quality, premium, or discount. All right, then let's now return to the concept of the inverse fair value gap. Now, what exactly does the market indicate to us? We are currently expecting the market to move downwards, form a red candle, and then where it forms a green candle, we will initiate our trade. But the market, you see, completely shatters this expectation. So the concept failed here, and the best part is no long entry was made because a proper closing will only happen when a green candle forms. For intraday traders on a 5-minute time frame, if you want to hold a bit longer, then for those on a 15-minute time frame, if you want to hold a trade for 4 or 5 days, then on a 1-minute time frame, if you want to close your trade within half an hour or an hour. So I told you about the time frames. So if this breaks, what happens then? People just close their laptops and leave. They forget about it. But if you carefully observe this, what exactly happens? Do not delete your established levels, neither the middle center line nor this specific fair value gap, even though it might have been breached. Now, if the market approaches this particular area, do you recall the green candle retest concept? It means the market broke out upwards, but then it failed. It came down and then it just fell like that. So we are trying to find this specific type of trade. Basically, you understand this trade now, and with a live example, it will become very clear. So we have to wait and see if it forms a green candle, if it forms yet another green candle, and somewhere around here, we will get an entry. We were basically looking for a long trade before this, right? You were finding one.
Should I create this stock market series? Do let me know by commenting. I'll make 25, 30 videos and give you a complete playlist. Thank you for subscribing. If you're new, please subscribe. Awesome content is coming. Let's get back to business. Now, guess what trick we're trying to find? Whether to sell or buy first, it won't know inverse FVG or FVG. So obviously, we're trying to trade the fair value gap. We are planning to sell, so we were planning to sell.
All right, it's here, brother. We're hoping for a red candle, a boom, something like that to happen.
The probability here often close their laptops and leave, but there is a chance for an inverse fair value gap to form here. Now, if the market comes here and forms a red candle, the entry for such a candle would be on green, and this would be my entry point. Guys, I need to make my entry right here.
Place at a stop loss at this level and set a target for a higher level. Obviously, this looks small, but this target will form above. Alternatively, you can also place your stop loss on this candle because the market usually doesn't break it again. So the actual right stop loss will be here below this red candle, and this will be your big target. All right, so I hope you enjoyed learning what inverse fair value gap and fair value gap are and where we apply them. All these concepts are applicable and work across all markets. Now, I'll take you to my laptop, and this strategy works most effectively in the Forex market, international markets, gold, crypto, and crude oil. To trade all of these, I would highly recommend the right broker, which is Exness, the one I personally use. You'll find its link in my profile, and opening an account through my link offers many benefits, primarily assistance with your withdrawals and deposits.
Your money is easily and legally deposited and withdrawn for you.
I've created another app called Market Genius where I develop trades for you completely free of charge. You'll also gain access to it, and all these details will automatically become clear to you once you join my Telegram channel. So first, open your account with Tux and install the Market Genius app. After that, all these things will automatically start becoming apparent to you. Now we'll switch over to my laptop screen. First, we're looking at our Ethereum chart here. This particular setup is based on a 1 hour time frame, so you can certainly develop and apply it to a 1 hour chart. I'll demonstrate it for you on the 1 hour, the 15-minute, and the 5-minute charts. So here, observe where you can spot a large candle and where you can identify a clear gap within it. For me, the most prominent gap, of which there are numerous examples, like here and also over here, and again right here. And we'll definitely use this specific example as well. I will explain to you. I look at the very first example, this candle that forms. When this candle formed, its body was very large, and there's a good gap in them too. So there should be a gap. The middle body should be large. So here I came like this and made it the high of this candle here. All right, so how is it? This one, this candle number 1, this 2, this 3. I saw it extend forward. So as it kept extending forward, bro, the market is so high, I'd make such a big entry. I don't know where I'd put the stop loss. And if I had entered, my stop loss would have been hit. So I deliberately waited for the market to come back into this level. Now, what did I say? How do you draw 50%? I endowment 50%. Look, what did I say? Like, come here and draw a 50% line. Drawing a line will be beneficial. You'll avoid cheap trades. As long as the market turns from somewhere here, you can avoid it. And when it turns from inside, you can enter. For example, the market came from here. It was inside, but there was no closing outside.
What did the market do then? It took a perfect touch of the handle.
If we enter here, what did I say? My goal was, after it touches below this 50%, if we enter here, we place a stop loss. Here's our simple fair value example. And we know the market has already given us a run up to this point. So if we extend this, we get 1.2332. Now, let me tell you a secret why it happens that while you're booking your targets, your market reverses, because everyone can see it. I can see it, you can see it, everyone can see it. So you'll deliberately make your target a bit smaller. If you need 1.3.4, 3.12, then we must book this trade like this. Okay, now I'll show you more examples. I'll show 2-3 more fair value gap examples. Then I'll show inverse value gap examples. If you like the video, then like it. Please like it. And I'm setting a target of 5,000 likes. I'll start uploading videos for the most commented list, be it Forex, crypto, or stock market. I prepared all 3, but what will I upload first? I'll upload it right away as soon as we hit 5,000 likes, guys. So this is the USD JPY chart. The stock. The market is in a good downtrend. And elsewhere, for example, a fair value gap formed here too. A fair value gap formed here, but the market didn't return. But I saw that a fair value gap forms here in a 1, 2, 3 setup. All right, the middle candle needs to be large. The middle candle is large, and this one is also a bit large. But okay, what's important to us is that though they saw this is going to be the first trade. So I genuinely need to take care of my stop loss. Now look at this gap of mine. Your stop loss gets hit, but it's targeted. Why does this happen? Why does it happen? Because you can see if this is my box, I will hit right here.
It's a hit, isn't it, dude? A bit of miserliness, what was taught in the target. You should leave quickly.
You should set your stop loss a little bit wider. Don't be stingy when it comes to this. Be conservative with your profit target, but never with your stop loss. That's how it should be, okay?
We know the market has run up to this point, right? So what will we do? It's the same old story. We'll take the target up to here. No, a little higher like this.
Aus politikernes Spar didn't click on so if we look here, what does the market do for us? It gives us a target of 1.3.7. Now I'll teach you something called pyramiding. What is the pyramiding concept? What do we always do? That when we're in a loss, we increase our quantity. The most important thing is when in the red, don't increase quantity. It's called averaging. Many people are losing money doing this. It's become a constant habit that when there's a loss, you just increase the quantity. That's called averaging, which is a very negative thing and a losing strategy. But if you do pyramiding means, now what happens? We placed a trade, shorted it, it started moving in our favor. Great, the market then turned and gave another opportunity.
It presented another opportunity. So take a look. When the market touched this level once more, where does a good red candle form around this point?
It's visible here. I'll just move it aside. Where do I spot a good red candle? Right here. Take this point or this point or this point. All right, I'll pick this one, I'll pick this one. So if we enter at this point, even if we've increased our quantity, what's the plan? One trade is already placed and we activated another trade here, thus booking a double target. So one is 1.7.2 and the other is 1.3.8. Overall, we achieved a 1-to-3 ratio. With double the quantity, the risk involved is quite small. So in this manner, not by averaging, but by pyramiding, you can truly make your money. What did I do? I made 15 rupees per unit. I invested 5 rupees. And what did I do? I repeatedly allowed it to enter a favorable zone. All right, I allowed it to enter a favorable zone right here. Now, if this is going to be my sell trade, then I'd want to, if this is my FVG and it's a sell trade, I would definitely want to sell above this 50% level. I mean here, not over here. If my buy trade is within the FVG, then I would prefer to buy it right here, not over here. This was a small new addition for all of you. If you follow this concept, which is known as premium and discount, it will prove to be extremely beneficial for your trading. Now, then I'll take you to the gold chart where I took a live trade and I'll show you how this trade made me $13,000. I'll show that too. Look what happens here, guys. In just 5 minutes, this is the short I made. Look, there are many comments on this video about FVG, so I'm making this video. Look at this huge candle, guys. If I look at the candle, it's 0.42%, a $12 candle. What am I doing now? I'm just showing you a small story. Whenever such a huge candle appears, man, it's even bigger than the previous 236 candles downwards. Now, obviously, I'd short here. I'd short here. Should I keep such a big stop loss? Man, the account will blow up with such a big stop loss.
If it worked out by sheer luck, but if it hadn't worked, then risk management would be completely meaningless here.
So what we have to do is simply wait. What you do is just come and develop a fair value gap right here. This is my first point. And then my second point, made it. Draw a 50% line and establish a rule that if the market trades above this specific level, then this becomes my designated sell zone right here. And at this point, I get a really good entry near that level. You can place your stop loss either above this candle or above this entire zone. There's absolutely no problem with that. Now just look at how far the market went back.
These are more common, and I'm showing you an example right now. Okay, obviously not all of them will work. It will work like 5 times, 6 times, 7 times at the right moment, but it won't work all 10 out of 10 times. So please keep this in mind. When you backtest this, please trust me on this.
Watch this video now, make your notes, and then check it yourself. You'll understand the rule I'm explaining to you. Enter it from below 50% properly from a good deep position. Right here, make your entry, go long. The stop loss clearly tells you, man, this is the point. You'll place it at this point, yet you're being stingy. Oh, put it a bit lower. How far is the target? The market has gone there before. The market went up to this level before. I always prefer the body, you know. You must have already seen this. I prefer body. Body works better than wick. Anyway, if you have any doubts, please ask in the comments. Now, the world knows the market will reach this point. See, it dropped from that exact spot, didn't it? I'll intentionally set the previous target like that. So if you observe, this creates a very nice trade here, like this.
And this develops in 5 minutes too. It's not like it only works at 15. This will develop properly in 5 minutes, and actually I might even get an early entry. I won't get my entry otherwise, and our entry will still be the same. And look at this beautiful trade here. It's a 1:2.6 ratio. What happened? A breakout occurred, inverse fair value happened, and we were looking for a sell here in the market. I didn't even get the sell entry. Then it directly broke out. So it went inside, touched the 50% line, and went up. So I entered, and if it had touched here, it would have been much more beautiful. A 70-75% win rate scenario. Let's look at another example. Forget it, guys. So here's the gold chart again. In fact, today, January 17th, the day that's currently underway, I'm making the video this evening on the 17th. And in it, you can see here that a market opens with a gap up, that it fills this gap, but then it creates a new fair value gap. So I'm creating a fair value gap here. Now, what do you think my intention is? Tell me that. I'm here looking for a sell trade. Let me just black this out first. What am I doing here? I'm supposed to be finding a sell trade, right? Because obviously the market is a little bit down. It's about to give me a really good sell trade. Okay? So what am I going to do? I need to make 50% profit here, and I found a good quality sell trade. Where did I find it? I found it right here. I have to short it right here. As soon as I shorten this, what happened here? This is that example I was telling you about. Sometimes we approach it this way, we get annoyed and give up, but look what happened now. Just take a look at what has happened here. It's right in front of you, and we'll shift this in 5 minutes. Oh, then you will easily understand. Now, at this point, it has triggered my stop loss. So I had sold right here on the red candle, on this very candle, and I had placed my stop loss somewhere around here, and it got hit. So I had to book the loss right here. Now, just look what the market did. It broke right through it. People will delete this. But if you look today itself in the morning, then at 12 p.m., it gave me a perfect entry. Even if it didn't give it from its 50% zone, it gave us an entry from here, and we can enter here and keep the stop loss a little below the 50%. Or look, this is also a wick, place it a bit lower. And if you look here, the market came up to this point, exit a little earlier. So say a 1:2, a 2-point trade is also available. Okay, this is a trade that I might actually avoid because it's formed from the upper level. Let's look at another example. Alrighty, guys, this is the US JPY chart. Seeing such a huge bull run, I wondered if it gave me a signal beforehand, allowing me to catch it. So look at this. To get a theorem of a teacher, my job is to show all examples, whether to take it or not. I've told you. The boxes below, any tricks that are 50% lower are better. Whether we take them or not, you'll backtest all of them, right? So do backtests. That's why I gave all these examples. Now look at this example. It was such a big bull run. Could I have caught it? I didn't see. Here, a red candle formed. There is a fair value gap here. Okay, I was planning to sell. So just look what happened here. It's going to be the same thing again. If you look here, we've made a fair value gap. So we took a short position right here. Let's say we shorted maybe at 50%. Then what happened? Our stop loss got hit, right? When your stop loss gets hit, do you get annoyed? But you need to accept it, move on, and then just wait. The meeting broke. The market came above the red candle. Look at the amazing green candle it formed. We won't enter at the red line, will we? What did it do? It grabbed all this liquidity by going to that lower level. What does wick mean? It shot up. We'll make our entry on this candle long. Now we can all see the stop loss. We see the markets at this point. Set it a little lower. Had the market gone above this anywhere before? No, it hadn't. Oh, it had. How far did it go?
Body. This is my body. It went up to here.